Today, September 24, 2025, gold is making headlines again. After a blistering run this month, bullion has hit fresh record highs and is sitting within striking distance of new peaks. In the next few minutes, I'll explain exactly why this rally is happening, what the biggest forces are that could push prices higher or send them lower, and a practical 48-hour outlook you can use to frame your own decisions. All facts I cite come from recent reporting and market data as of today. Disclaimer: this video is for informational and educational purposes only and is not financial, investment, tax, or legal advice. I am not a licensed financial advisor. Do your own research before making any investment decisions. Commodities and futures trading carry a high degree of risk and can result in substantial losses. Past performance is not a reliable indicator of future results. The views expressed here are my own and are based on public reporting as of September 24, 2025. Always consult a licensed professional for personalized advice. As of today, spot gold has been trading around the high $3,700 per ounce, briefly touching record highs earlier this week before pulling back a bit during U.S. trading. U.S. futures and multiple ETFs have seen elevated flows and volume as investors react to central bank activity and macro data. Why gold just surged? The big drivers. Fed rate expectations are shifting. Markets are increasingly pricing the chance of U.S. interest rate cuts later this year. When traders expect lower future real yields, gold becomes more attractive because the opportunity cost of holding non-yielding bullion falls. Recent central bank commentary and market pricing are the primary catalyst behind the latest leg up. Geopolitical risk and safe haven demand. Renewed geopolitical tension, public warnings from major security organizations, and heightened conflict rhetoric is boosting demand for safe assets. When geopolitical risk spikes, investors often rotate into gold for protection. Central bank buying remains a structural force. Central banks have been net buyers of gold for years, and their appetite has accelerated since 2022. Those official purchases, often driven by reserve diversification strategies, remain a persistent source of real physical demand. Recent analysis shows central bank buying is still materially supporting prices. ETF flows and retail and institutional interest. Physically backed gold ETFs are seeing strong inflows this month. These funds act like standing buyers of physical metal, amplifying price moves when flows surge. The World Gold Council's ETF flow data shows a meaningful increase in allocations to gold products in recent weeks. China and global demand dynamics. Reports that China is moving to expand its role in global gold custody and market infrastructure have added an extra structural narrative. If China further integrates gold into its financial plumbing, custody, clearing, or official programs, it could increase both official and private demand over time. That narrative has helped push sentiment into bullish territory. The technical picture. Technically, bullion is at record territory, with short, sharp pullbacks after each new high, typical of an exuberant but healthy rally. Momentum indicators show strength, but volatility is elevated. The same reasons that push gold up fast, rate cut hopes, geopolitics, buying flows, can cause intraday pullbacks when the dollar or yields move quickly. The 48-hour outlook. Below, I frame a clear, practical 48-hour scenario plan. I'm not giving advice, I'm laying out likely market reactions and the key data and events that will most likely move gold over the next 2 days. Key events to watch. These will drive moves in the next 48 hours. Any comments or signals from the Federal Reserve, including remarks from Fed Chair Powell or regional Fed presidents. Hawkish tones, dollar or yields higher, pressure on gold. Dovish tones, dollar or yields lower, tailwind for gold. Major U.S. economic prints, particularly inflation gauges, PCE, CPI surprises, and employment numbers. Stronger than expected inflation or jobs data, higher yields, potential short-term pullback in gold. Weaker prints, gold rallies. Short-term geopolitical headlines. Any escalations or calming headlines will swing risk sentiment quickly and gold with it. Scenario A. Bullish continuation. Base case probability, moderate to high if next 2 days contain dovish Fed tone or softer economic data. What happens? Gold holds above recent support levels in the 3,700s, tests and potentially breaches the 3,800 area again, with renewed ETF flows and more headlines about central bank buying. Retail and institutional buyers treat dips as buying opportunities. Why? Market pricing for rate cuts stays intact or strengthens, geopolitical risk remains elevated, central bank flows continue. Scenario B. Short, sharp pullback. Base case probability moderate if strong U.S. data or hawkish Fed comments. What happens? A stronger USD and rising real yields trigger profit-taking. Spot briefly falls several percent intraday. A move of $50 to $150 is plausible in volatile conditions, testing 3,600 to 3,650 as short-term buyers reevaluate. Selling pressure from traders and futures deleveraging intensifies the pullback. Scenario C. Volatile grind with two-way swings, if mixed economic data or contradictory headlines. What happens? Choppy trading with intraday whipsaws as investors digest conflicting signals. Central bank buying versus data pushing yields up. Volatility rises, ranges widen, ETFs and algorithmic traders amplify moves both ways. Bottom line for the next 48 hours. Gold's short-term path will be dominated by U.S. macro surprises and Fed tone. If you must watch one thing closely, any new public remarks from Fed officials and the latest inflation or PCE data. Those will likely dictate whether scenario A or B plays out. What to watch beyond 48 hours? Sustained central bank buying. If central banks keep net purchases high into Q4, that's a structural support that can push gold to new nominal records. Dollar trend and real yields, the most reliable macro link to gold. A weakening dollar and falling real yields underpin higher gold prices. The reverse can trigger larger corrections. Physical demand seasonality. Festivals, wedding season in India, and Chinese buying patterns matter for real physical flows and can drive transient surges in nearby markets. Common listener questions. Is this a bubble? Answer. Record highs don't prove a bubble. They show strong demand versus supply at this moment. A bubble requires speculative excess detached from fundamentals. Current buying has structural elements, central banks, ETFs, and geopolitics that justify higher prices in many analysts' views. Will gold hit $4,000? Answer. Hitting round numbers like $4,000 is possible if dovish surprises stack up. Central bank buying continues and geopolitical risk persists, but price forecasts are probabilistic. Analysts and houses have range-based views. Some models see $3,800 to $4,000 as reachable this year under certain conditions. Today, gold is riding a mix of rate cut hopes, central bank demand, and safe haven flows tied to geopolitical stress. Over the next 48 hours, watch Fed commentary and U.S. inflation and employment prints. Those are likely to be the deciding factors between a fresh leg higher or a short, sharp pullback. For any moves you consider, treat this as information, not advice.